Thank you for joining me on this video. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals helps you understand both the direction of the trend and the level of risk in the stock market through our proprietary indicators that are emailed to you every weekend in our weekly stock market-based newsletter, all for less than 67 cents per day. Today we will be doing technical analysis on the S&P 500 for the week ending Friday, July 17th, 2020. For this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. For the week, we were up 1.25% on the S&P 500, and we closed at 3224.73. The first chart that we're going to look at here is a one-year weekly candlestick chart of the S&P 500. The blue line is set at 3,200. So as we can see here with the annotations, the verbiage that I've already written on this chart, this week was only the 11th week in the entire history of the S&P 500 where we closed above 3,200. The last time we closed above 3,200 on the S&P 500 was the week in February, where we had hit the all-time closing high, which on a daily basis so far is 3386.15, and that was on Wednesday, February 19th. And of course, from there we rolled over and went down to our lows so far for this correction, just below 2,200. On the S&P 500. So this was a decent week in the S&P 500 and very critical that we were able to get up and close above the 3,200 level on the S&P 500. But just because that happened, don't assume that this is a risk-free environment and that we're all set to go and we're off to the races. So just understand that this was the 11th time, only the 11th time in history that this has ever happened. And we are now back up at these levels on much lower earnings, at least 20 to 25% lower earnings than what we had on the S&P 500 back in 2019. So we're doing this on the hope for continued stimulus and the hope for a vaccine for the coronavirus. And we're doing this on expanding multiples, not on growing earnings on companies. So with that said, let's move on to the next chart. So for the week, what we can see here is the performance of each individual sector within the S&P 500, and we can see what worked and what didn't. So the industrial sector was up the most, up 5.85%, followed by materials up 5.43%, healthcare up 5.13%, and utilities up 4.26%. So as we can see, it was the more defensive, more cyclical sectors that actually worked this week. What didn't work are the things that have gotten us up to this point, the more growth-oriented companies and sectors. They did not perform well this week. The tech sector was down 1.14%, and communication services, which is where Facebook is found in that sector, was down 0.54%. And again, we can see that the S&P 500 as a whole was up 1.25% for the week. So I don't get too excited when I start to see, these industrials and materials and utilities drastically outperforming tech. So just understand that this was a much more conservative movement in the S&P 500 this week. It was more defensive sectors that actually worked. And oftentimes that is not great news. It was good news from a breadth standpoint. It really widened out the breadth in the market. But just understand it was more of a defensive rally for the week. Now what we're looking at is a hourly chart of the S&P 500 going back 6 days. So I started this back on Friday the 10th of July just so we can see where Friday finished up. And of course on Monday we gapped up at the open on Monday the 13th. And you can see here that we had an intraday reversal on Monday and closed at the lows of the session. We gapped down on Tuesday and then rallied for the balance of the day. We gapped up at the open on Wednesday. And so for Wednesday, Thursday, and Friday, basically what we can see here is we traded between about 3,200 on the low end and 3,230 on the high end. And this is super important for us to know going forward. And look, isn't this interesting that we had no hourly candles that could close above 3230, but we were able to stay above 3200 on the S&P 500 on these hourly closes for the balance of the week. So the majority of the week, minus Tuesday, we traded between 3200 and 3230 on the hourly closes on the candles. This is really important for us to understand going into next week. We've got earnings on a lot of companies starting here over the next couple of weeks. And so the question is going to be, the question I'm going to be asking myself, right, and the things that I'm going to be watching is, can we continue to close above 3,200 on the S&P 500, and can we get above 3,230? And that will be important for us to understand as we look at this next chart as well. Okay, so this chart is a hourly chart of the S&P 500 going back to May 26th. And the first thing I want to point out is that the bulk of our trading from May 26th to current has happened between 3,000 on the low end, which is where this lower blue line is set, and 3,180 on the high end. So most of the trading on the S&P 500 since May 26th has been between these two boundaries, which is a 6% movement. Okay, so we can see here that this week we were able to get above this 3180 level, which had really been giving us fits. As we can see, we had 1 hourly close last week, right? We closed on Friday at just above 3180, and I pointed that out last week. And the question became, can we get above that 3180 and close above it and continue to close above it? Well, of course, we gapped up at the open on Monday, rolled over, got once again below this area, but finally penetrated and started to close above 3180. And as we know, for the majority of the week, we were able to close above 3200. But when we go back and look to the left and go back to June 8th, what I think is so interesting is after we made that bottom on March 23rd and came back up, we've had 1 hourly candle that's been able to close above 3230 on the S&P 500, and that was on June 8th. So it will be really interesting over the next week or two to see if we can get above this 3230 level, either on the hourlies and, of course, then again on the daily candles, and see if we can continue to close above, number one, 3,200, but then can we start to close above 3,230 going forward, or is this 3,230 level going to act as overhead resistance? And you can clearly see that on this longer term, right, this kind of a 2-month hourly chart on the S&P 500. You can see how important this 3,200 level is, and then this 3,230 level. So if you're working in the S&P 500, if you're a trader, if you're an investor, just understand that we really do need to stay above 3,200. If we close beneath 3,200 anytime next week, 3,180, there is some support right there. It's not a ton of support. If the 3180 level does not hold, then we're probably going to find ourselves somewhere down here, around 3100, maybe 3150 on the S&P 500. So it will be important next week for us to stay above 3200 if this rally is going to stay intact. Now what we're looking at is a 5-year weekly candlestick chart of the IWM, the ETF that tracks the Russell 2000 Small Cap Index, and we finally had a weekly candle that closed above the 40-week moving average on the Russell 2000. So the small caps participated to the upside here. We were up 3.73% on the Russell 2000, the IWM that tracks the Russell 2000 for the week. So pretty good week in the small caps. We're starting to get a little bit more breadth in this market, which is very good news. And the DIA, the ETF that tracks the Dow Industrials 30, also had a better week this week, and we finally closed above the 40-week moving average there as well. The DIA was up 2.35% for the week. Now what we're looking at is a 1-year daily candlestick chart of the triple Qs, the NASDAQ 100. The first thing I want to point out is how far above the 200-day moving average, this orange line, the triple Qs are trading. Now, they did pull back a little bit for the week. We know that, but they're still trading above their 20-day moving average, the green line here, the 50-day moving average, the blue line here, and well above the 200. The reason this is important is that we are starting to get a negative MACD indicator on the triple Qs. And so we're starting to see some weakness there. And if the triple Qs, the NASDAQ 100, and the XLK, which is very similar to the triple Qs, but the XLK, this is the tech sector within the S&P 500, and we can see that, again, we're trading well above the 200-day moving average. Too far, in my opinion. We're overdone here, right? We're overbought, if you will. The triple Qs, the XLK, these areas, these tech stocks need to pull back a little bit and take a breather. And again, we've got a negative MACD on the XLK. So we're starting to see some negativity in the trading on the tech sector, on these large cap tech stocks, and they've just now started to pull back. So the reason I'm stressing this, guys, is if over the next couple of weeks we continue to see weakness in the large cap tech stocks, the XLK, the triple Qs, I believe it's going to be difficult for the S&P 500 to continue to move forward if we continue to see weakness in large cap tech. And again, the large cap tech stocks are trading well above their 200-day moving average, 20+%. So I would not be surprised to see these things pull back to at least their 50-day moving average, if not a little bit lower, and even a pullback to the 50-day moving average on the triple Qs on the XLK is going to be about a 7 to 8% pullback from where we closed right here. So if you do use the MACD indicator, watch that, and as long as there's weakness, as long as there's divergence in that MACD, as long as it's negative, I think it's going to be very difficult for these tech stocks to continue to advance, and that's probably going to negatively affect the overall market, at least in the near term. Now what we're looking at is a chart of the S&P 500 for the first 3 months of 2020, so January through March. And I've annotated this chart with the simple market signals to show you how simple market signals can help you understand the risk levels and the changing risk levels in the stock market, and how simple market signals can help you manage your risk. The simple market signals are green, yellow, and red. Green is the lowest risk level in the stock market, and what you're going to find is the stock market makes most of its upward progress when the signal is green. When the signal is yellow, that means that risk levels are starting to rise, and what we can expect in a yellow environment is sideways to slightly up or down price action. And the red signal is the worst signal in the model, and you're going to find that the worst sell-offs, including bear markets, happen when the signal is red. So let's walk through this and see how this works. So we came into the year with a pretty strong stock market, as we know, and the signal was green for the majority of January of 2020. On the 27th, the signal went to yellow, and we had a yellow signal for about 2 weeks here. As we can see here, the signal went back to green for a few weeks. We know that we hit our all-time high in the stock market on Wednesday, February 19th, 2020, where the S&P 500 closed at 3386.15. And then we had this negative reversal that I had talked about in my newsletter to my subscribers, and I had told them that I did not like this price action because we did not have the follow-through. We hit that all-time high in the stock market, and then we had this negative reversal, sold off on Thursday and Friday. And so in the newsletter that went out on Saturday, February 22nd, I was warning my subscribers that I felt like something was changing and that they should be ready to take defensive measures and protect profits. And sure enough, the signal went yellow on Monday, February 24th. So I hope you guys are paying attention to how this can really help you manage your risk. And think about what happened here, okay? We hit an all-time high in the market, and then just a few days later, the model showed that there was rising risk, and the signal went yellow on the 24th. Now, over and above the risk signals, I have trend indicators in this model. The longer-term trend indicator, called the general trend indicator, went negative the very next day on 225. Okay, so the signal went yellow, right, on Monday the 24th. On Tuesday the 25th, the general trend indicator went negative. So there's two warnings right there, right, that something is not right in the stock market. And by the way, the general trend indicator had been positive since October of 2019, okay, since early October 2019. So think about that. The signal went yellow. The very next day, the trend indicator went negative. That trend indicator had been positive for months. Okay, so there's numerous ways that simple market signals can help you manage your risk. So there's two things right there within 2 days that could have told people that they probably should take some profits, rebalance their portfolios, take defensive measures, buy puts, however you want to protect your portfolio, right? That's up to you. But you can see here how this is working. And then by Thursday, the 27th, the signal had gone red, okay? And by the way, that signal went red at around 3,000 on the S&P 500. And your first warning came out at about 3,250, okay? So, and the second one came out somewhere, around 3,100. Let's just call it 3,100. So you had numerous warnings all within 1 week. You had a yellow signal. You had a negative general trend indicator. Again, that thing had been positive for months. And then the signal went red. And as we know, the market sold off very hard from there. Guys, this is just one example, but a very recent example of how simple market signals can help protect you, okay? And regardless of whether you're trading the S&P 500, the DIA, the triple Qs, individual stocks, the correlations in the stock market they're so high these days that if you understand what's going on with the S&P 500, and my model is based on the S&P 500, but if you can understand what's going on with the S&P 500, irrespective of what you're trading, it will help you understand the general direction and the general risk levels in the stock market, okay? Because as we know, 70, 80, 90% of all stocks go in the same general direction as the S&P 500. So if we can understand what's happening with the S&P 500, it gives us a huge advantage in trying to manage our risk and protect our profits with our investments. Okay, a quick refresher on the Simple Market Signals weekly signals and how they can help you. The signals are green, yellow, and red. The green signal is the best risk-reward ratio for equity investors, and what you're going to find is that the stock market makes most of its upward progress when the signal is green, okay? The worst risk-reward ratio signal for equity investors is when the signal is red, and what you're going to find is that bear markets and the worst downturns in the stock market happen when the signal is red, like during the 07 through 09 bear market, as we see here. So again, the best risk-reward ratio signal for equity investors is when the signal is green, and the worst risk-reward signal for equity investors is when the signal is red. As part of the Simple Market Signals model, there are three powerful indicators. There's the Simple Market Signals proprietary risk level signal. There's the short-term trend indicator, which helps clarify short-term moves in the overall U.S. stock market. And a normal signal length for the short-term trend indicator is anywhere from 1 or 2 days to 7+ weeks. Then there's the general trend indicator, which is designed to stay positive during the bulk of most uptrends and negative during the bulk of most downtrends. And a normal signal length for the general trend indicator is anywhere from 2 weeks to 5+ months. We disseminate the information through the Simple Market Signals weekly newsletter. In the weekly newsletter, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the short-term trend indicator signal. You will also receive the general trend indicator signal. You will also receive market and sector performance information over multiple time frames. You will receive a recap of what happened in the stock market for the past week. You'll also receive technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information every week in the Simple Market Signals newsletter. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents per day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. And guys, I want to set realistic expectations here, okay? The newsletter isn't fancy. It's effective. It's plain text, no color, no fluff. And please note that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. Now let's recap what you will get with your Simple Market Signals subscription. You will get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there's a major signal or direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to get that information to you as soon as possible via a special midweek update email. The best fit for a Simple Market Signal subscriber is an investor or trader with at least a 6 to 8 week plus time frame that they're focusing on. If you're a day trader or a really short-term trader, Simple Market Signals may help you a little bit, but the reality is Simple Market Signals is designed for those investors and traders with at least a 6 to 8 week plus time frame that they're focusing on. And if you would like even more information about how you can benefit from Simple Market Signals, I have the following videos that will be linked in the description box below this video. And to subscribe to Simple Market Signals, you just need to go to the website that you see on the screen here. That's https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that easy.